Hi and welcome to Swiss Codes Daily Market Talk. It's Friday, February 7th. Amazon reported better than expected results yesterday after the bell, but investors concerned with high AI spending and slower cloud growth sent the shares lower in the after hours trading. Happily, though, the easing yields around the world, waning trade worries from Donald Trump, and not that bad earnings overall give some support to the stock valuations on both sides of the Atlantic Ocean. In the sense, stocks in Britain and Europe are at record high levels, and all eyes are on the US jobs data before this week's closing bell. Now, it feels kind of empty when you don't have a bomb from Donald Trump falling in the middle of your trading day, doesn't it? But yes, yesterday was one of these days. It was a relatively calm day in terms of Trump surprises. So we can do this emission without talking about Trump, guys. So that was a challenge that was proposed to me. So Monday's trade tensions have been waning gradually. Last week's DeepSeek shocker is also quite well digested among global technology investors as we are preparing to end this week. Earnings continue to flow in, on the other hand, and reinforce the narrative or the fear of rising AI spending and slowing growth. And in this context, Amazon, that reported its latest quarterly results yesterday after the closing bell, was the latest to post better than expected earnings and revenue for the fourth quarter of last year, but a slower growth of its cloud division. And the company also warned that the current quarter profit will be missing the market expectations. Why? Well, mostly because it's spending just too much on AI. So investors sent Amazon shares 4% lower in the after-hours trading, and that despite an 86% increase in the company's EPS since last year. As a result, Amazon won't be printing a post-earnings record high when the US markets open today, but the rally in Amazon's share price has actually been quite strong and accelerating lately, and the company is still at a bright spot for AI investors, given that the AI and robotics could lead to important progress in productivity and in lowering costs across their business units and give the company a sustainable boost for its future revenue. So I always liked Amazon as an AI play, and I continue to like it, and I like it even better at the depths. All in all, 6 of the Magnificent 7 companies of the United States have reported their earnings so far, and they collectively reported a revenue growth of approximately 10% year on year. Obviously, we are talking here for the fourth quarter of last year, and the combined net income for these 6 magnificent companies of the United States increased by about 15% compared to the same period a year before. So these are big numbers, but not as impressive as they have been before, because the companies also gave a cautious outlook for the coming quarters and said that they will increase their AI spending to make sure to lead the AI dance. So among the 6 of these magnificent companies, investors weren't too sure, but Meta has been the brightest spot as the company is about to launch its own AI model, and Mark Zuckerberg wants 1 billion users globally to join in. We'll see if he can do that, but the stock prices are giving some positive signs, while Tesla has been the least convincing as the rising global dislike for Elon Musk starts seriously taking a toll on companies' sales. Voila. Zooming out, the S&P 500 and Nasdaq 100 are quite well surviving the less than wow big technology earnings this earnings season. Both indices hang on near their all-time high levels. The easing US yields certainly give a hand to valuations as well, and that despite uncertainties regarding what the Fed should do next. So this week's US jobs data has so far given mixed signals regarding the state and health of the US economy, with lower job openings in December, lower job cuts during the course of last year, but a jump in terminations in the month of January, then weaker labor productivity, but a weaker than expected jump in the labor costs as well in the US, and also a stronger than expected ADP employment print on Wednesday. So today, the official US jobs data is expected to print around 169,000 new non-farm jobs added in the US last month, with a slightly slower wages growth and a stable unemployment rate near the 4.1% level. But note that we will also be watching quite closely the annual revisions to these jobs figures, as we do every January report. And note that the early estimates in August actually hinted that the US jobs numbers could see a downward revision of more than 800,000 jobs. But wait, economists expect that the downward revision will rather be around 600 to 700,000 jobs. So if that's the case, the week will be ending with the narrative that the US jobs market is healthily slowing, which would be a scenario that would allow the Federal Reserve to continue cutting its interest rates, but not hurriedly, and keep the market sentiment at a sweet spot. A weaker than expected NFP figure today and or rising wages would weigh on sentiment on the other hand, while a stronger than expected NFP number, if combined to softening wages growth, would reinforce the Goldilocks scenario. So the US dollar, which has been supported lately by safe haven flows toward the safety of the US dollar due to Trump trade worries, has reversed its course since Monday's jump. So a set of US jobs data in line with market expectations should lead to a further pullback of the US dollar's valuation against most majors, yet the dollar's depreciation is expected to remain limited against the European currencies given the relatively more dovish outlook from the European central banks compared to the Fed. And by that, I mean the European Central Bank and also the Bank of England. And indeed, the Bank of England announced a 25 basis point cut yesterday as expected, but two members wanted to cut by 50 basis points. And when asked for Rachel Reeves' growth plan for Britain, the Bank of England members actually said that this is the right thing to do. But hey, the Bank of England lower its growth forecast while lifting its inflation expectations. So that's exactly the opposite of what you would call a successful outcome for an economy or for Rachel Reeves' growth plans. So the pound came under a renewed selling pressure against the greenback yesterday after the BOE decision, and weaken against the euro as well. The FTSE 100 index, on the other hand, advanced to a fresh all-time high level. Miners there led the market rally, with Rio Tinto, for example, adding more than 2.5% yesterday, and Anglo American rallying more than 5%. Across the channel, the STOXX 600 index also hit a fresh all-time high level yesterday, reflecting strong earnings in the European healthcare companies and also prospects of supportive European Central Bank policy in the coming quarters. In the energy space, while US crude extended losses toward the $70 per barrel psychological level yesterday, now we see some dip buying near this level this morning, but overall, the Trump trade policies, well, they do hammer global growth prospects and will probably end up sending the barrel of US crude below the $70 per barrel level. And a further fall in crude oil prices toward the $65 to $68 per barrel range now looks like plausible to me. That's good news for global inflation, obviously, yet note that in Europe, the European natural gas prices keep climbing, and they're climbing on the back of rapidly falling European natural gas stockpiles. And the idea that the big storage sites in Europe will be replenishing their natural gas reserves at high prices instead of waiting for the prices to fall actually supports the positive trend that we see in natural gas prices in Europe, and somehow raises questions among the European Central Bank, those on whether the ECB could keep inflation under control when the energy price outlook looks somehow unideal. I guess we shall see. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.